Hello everyone. Our final research project is stock market prediction based on sentimental analysis. Our team members are Srinivas Tabeta and Suraj Kantara. Um, Here the introduction of the stock market prediction based on sentiment analysis. From the past decade, the investors are finding new patterns in the data available from the stock exchanges due to the rapid growth in social media. The new correlations between public sentiment and stock prices have been observed. Previously, investors relied on their experiences and their intuition to predict the stock prices, which are mostly unreliable because they miss many hidden patterns in trading. We are now trying to use the tweets and finance data to predict stock prices. Next slide is proposal system. This is the proposal system. In proposal system, data collection, data cleaning, and pre-processing will be done. In The collected data in pre-processing will be fed into these two models, LSTM model and ARMA model. The collected data from these two models will compare here. And the next slide is about data collection. In a proposal system, the first stage is data collection. The data is collected from the finance API and the Twitter API. We have collected Apple tweets from Twitter API, and we have Apple stock prices from 2016, around 3 years of data. And the next slide is about data pre-processing. In data pre-processing, the data will be collected from data from Yahoo Finance API and data from Twitter API. First, we will collect the data from Yahoo Finance API and Twitter API. The data from Finance API is clean, like removing null values from the data. And the next, the data from Twitter, we will be remove the hashtags, usernames, and unnecessary characters, etc., which will decrease the performance of sentimental analysis. The data collected from the Yahoo Finance and the data collected from this sentimental analysis will combine and we will store as a CSV here. And the next slide is how we perform the sentimental analysis. We will perform the sentimental analysis by using the machine learning library like TextBlom. It is already a trained model. We will get the polarity of each tweet and look at the polarity of all tweets on a given date, and we will find the average polarity here. Now the polarity of the tweets on a given day will be appended to the market data obtained from the Yahoo Finance. And the next one is mm, data after processing. This is the data from here: open, high, low, close, and adjusted close, volume, and the Twitter polarity and the Twitter volume. It will be and here from will be continued by Suraj.
Thank you, Pavani. I will be taking from here. We will be using two models in our proposed system, which is LSTM and ARIMA. LSTM stands for long short-term memory, whereas ARIMA stands for autoregressive integrated moving average. LSTM is a sequential artificial neural network model, which is developed to work with unsegmented data like images, movies, and etc. Whereas ARIMA is a statistical model. Basically, ARIMA is an univariate model which can be made multivariate by passing other variables as exogenous parameters. And when it comes to LSTM, it is most used neural network, and it is also used for time series data. We will apply the rolling window technique on stored CSV data with a window size of S with a window size of 3, which means we will be using previous 3 days data to forecast. We will then perform a minimum maximum scalar, a min maximum scalar for normalization of data between ranges 0 and 1. And then after that, we get the data to desired shape. We split the data into 70-30, which is training and testing ratio. And then after we prepare data, we will start to build the LSTM model using Keras. Now we will test the trained models and we will forecast the data into future. The predicted values are fed into inverse min-max scalar to obtain the original values, and we will then calculate the model performance. So this is something which is the flow of model with LSTM. And next, this is how the building model is. While building the model, we use the following parameters. So 3 LSTM layers and dropout fraction as 0.2. We use the Adam optimizer and the mean square error function for calculating the loss. We used dropout fraction to prevent model overfitting, and we will train the model with trained data. So this is some information regarding ARIMA. It is a statistical model, which is basically a univariate model. ARIMA stands for autoregressive integrated moving average. Even though it is a univariate model, we can make it a multivariate model by adding extra variables, which are known as the exogenous variables, making it a multivariate model. And now it's a model with ARIMA. In ARIMA model, important thing is the time series that needs to be stationary. To make the time series stationary, we will subtract value from the previous value in time series. This is called differencing, denoted by D. There are two more parameters, P and Q for ARIMA. P is the order of autoregressive AR, and Q is the moving average order, which is MA. Then further information will be explained and discussed by my friend Srinivas. Thank you for giving me this opportunity.
Thanks, Suraj. I'll be taking from here. As Suraj said, we have 3 parameters P, Q, and D, which we need to find before building the model. So in order to find D, first the test data or the training data should be stationary. In order to check whether the training data is stationary or not stationary, we had some test known as augmented Dickey-Fuller test to find if the series is stationary. This test has an output variable P. If the P value is less than 0.05, then the series is stationary. If not, the series is not stationary. Now, we have performed augmented Dickey-Fuller test on our training data. As you can see, we got a P value, which is 0.6, which is very much greater than the 0.05. So we need to perform differencing to make the time series data stationary. We'll perform the differencing, and we'll plot the autocorrelation plot of the differencing. And with the help of these correlation plot, we will know the order of differencing, which means the D value. As you can see, first, without differencing, for the original data, if you perform the autocorrelation, it is not approaching 0 as quickly as possible. After one differencing on the original data, and if you plot the autocorrelation plot, it is instantly going to instantly approaching zeros. And if you try to difference it again, it is autocorrelation plot shows that more values are going into negative, which is not good for the model. So we will stick with the d equal to 1. After finding the d, we use partial autocorrelation function plot to find p and q values. P value is also determined by autocorrelation, partial autocorrelation plot. P value is how many values are crossing the significant limit in the partial autocorrelation plot. Here you can see there are none except the zeroth. None of the values are crossing the significant value, which means p equal to 0. Q value is determined by PACP, determined by partial autocorrelation function by no value of those number of value of those that are well over the significant line. As you can see, there are no other lines that are well over the significant line. That means the Q value is also equals to 0. After finding these P and Q D values, we will build the model with these values. Or there is a function called AutoArima to find these values automatically. After building this model, we'll split the data into 70:30 train is to test ratio. In the Twitter data, and the main thing is Twitter data is passed as exogenous input. That means Twitter data is like a polarity of tweets, average polarity of tweets on a given day on a given company, for a given company, will be fed into the model with model as exogenous inputs. So you can see over here, this is a description of our model. It is using ARIMA Q equal to P equal to 0, Q equal to 0 and D equal to 1. And you can see Twitter polarity at Twitter volume are the exogenous variables here. Exogenous variable over here. So after that, then we'll train the data with these built models, and we'll go for the results what we have got from this. This is a plot of stocks for Apple stocks for the next 17 days using LSTM and predicting the next 120 days using LSTM. As you can see, whereas the orange line is the original values and the blue line is the predicted values. These values, you can see the root mean square error for these models is 0.96, which is not that much acceptable. And if we increase the predicting days to 120, the score gets worse. So 1.6, which is not at all acceptable. Now, if we try to compare it with ARMI model, predicting the for 17 days, 0.147, which is well acceptable, and which is usually RMSE value should be less than 0.75. So you can see this is well below the 0.75 and it is more acceptable. But if you increase the days to 120 for into the future, the RMSE values getting worse, but it is still acceptable, which is lying around 0.29. So from this, we can conclude that from this experimentation, we can conclude that both LSTM and ARMI are helpful in predicting the stock prices, but LSTM performs little bad than when compared to ARMI, and both the models have significant loss when we are predicting long term into the future. And also we can conclude that experiment shows that statistical models in certain times, statistical models perform way better when compared to the machine learning models. Thank you. That is from our side. Thank you, everyone.